James, can you provide us with a high-level recap of 2020?
Yeah, thanks, Chris. Thanks for having me. The fourth quarter of 2020, equity markets continue to rally, and it was the third consecutive quarter. Equities significantly outperformed fixed income. And part of the reason for that, US election results, and then also positive news around COVID-19 vaccines. I mean, there are specific dates. November 9th is a great example. You'll see from there forward, markets really turned around pretty quickly. That was the day that COVID vaccines were announced to be approved, and they were going to be put in arms in the next 30 days. That certainly helped more cyclical segments of the market to recover. For instance, value stocks rose by about 17%. They've had their best quarter since 2009. And maybe even more spectacular, small cap stocks, which had lagged at the beginning of the year, returned 24% for the quarter, which erased the entire underperformance versus large cap for the year. Certainly growth equities, so think of your tech companies, et cetera, they continued to gain, but were underperforming versus other equity asset classes for the quarter. And then kind of lastly, rising commodity prices, which had really fallen off as travel demand and manufacturing fell off in the first quarter of the year, were driven up by strong demand, specifically from Asia. Oil prices rose, again, aided by that vaccine news. So overall, a very strong quarter to own equities.
So James, I think for the average investor, many of us are left scratching our heads trying to understand market performance in 2020. Since the March drop, we saw tremendous growth despite a languishing economy, political upheaval, and a job crisis worse than the Great Recession. In previous cycles, any one of these factors would have likely turned markets downward. What's different this time?
Yeah, that's a great question, and I think that it's very common for every investor to think about that. It's worth noting COVID-19 as a pandemic produced a very pronounced economic shock, maybe the greatest one in nearly a century. There are kind of four components to what happened in 2020, and then also how that carries forward into 2021. But I think when you think about the question that you asked, it certainly falls in the first bucket, which we would consider there was a profound yet ultimately temporary setback, right? I mean, social activities and industries that have been most reliant on them are going to rebound. And again, you have to think about equity markets. They're forward-looking. They're pricing in all available data on a go-forward basis. So they're taking into account, is this a permanent change, right? Is this industry going away forever? Or is this a temporary change? And certainly, I think the market is pricing in that most of this is a temporary change.
Gotcha. Well, let's hope it is temporary for sure. So what fueled Wall Street's resurgence in 2020? I have to imagine that some sectors were drivers for growth and others may have struggled to meet their typical performance. Can you provide us a little insight there?
Absolutely, really. There were a couple of, again, so I mentioned four buckets, kind of the second, third, and fourth bucket. What we would deem to be an accelerated future is the second bucket, which is very simply trends that analysts and our research staff have already identified were in place prior to COVID-19. Let's see, online retail, working from home, telemedicine. These were all things that already existed prior to COVID-19. COVID-19 simply accelerated that future. Companies that were positioned in those industries, again, think technology companies and some other medical companies, did very, very well for the second, third, and into the fourth quarter. The other big difference was a very quick pivot in policy across all countries across the globe, right? So what we saw in this particular recession in the first quarter was a much faster response out of global governments, right? Policymakers were aggressive in supporting financial markets right from the beginning. They didn't wait for things to bottom out. And I think that really propped everything up until the market could get underneath itself a little bit.
Thanks. So, James, 2020 may set a new record for charitable giving in the United States, given both the tax incentives that we saw baked into the CARES Act, as well as the record performance of the market. Is there a link between market performance and charitable giving?
I think there's a direct link, right? I mean, the way that we look at it is not just from a an equity return basis, but we also look at consumer confidence, and those two tend to go hand in hand. And when you look at that, there is a direct correlation, and it makes sense, right? As someone feels better about themselves and their situation, they tend to look outside of themselves and how they can help others. And certainly, I think this year, because this is not just a market phenomenon. The market wasn't just up a lot this year. It wasn't a strong return year. There was also a health crisis that, touched a lot of people and kind of connected people, maybe in a way that hadn't previously happened. So I think that both of those played a factor this year.
So one of the things that I've been thinking about is the wild success that we've seen in the markets this past year certainly highlights the significant disconnect that can occur between the markets and the overall economy. But what, if anything, does this optimism that we've seen play out in the last quarter of 2020 potentially telegraph for the greater economy as we're looking forward into 2021?
Well, I do think that there's a lot of information in there, right? I mean, again, we're looking at a lot of these setbacks are temporary. They also have and you hate to say it this way, a feeling because of the isolation that we've had, lack of travel, lack of connectivity. You look at something like unemployment, and again, not to make light of anyone's job loss. Current unemployment in the United States right now is about 6.7%. Historical average is 5.77%. Not that 1% isn't meaningful, but the reality is we're not that far off as far as unemployment goes. And again, a lot of these industries that have had downturns in the first and second quarter, they've already rebounded or they've begun to rebound. Again, think energy, traditional retail, hotels, airlines, financials. They've all rallied kind of post-November when the vaccines were announced. And then on the other side of that, there's been a little bit of a kind of a reversion to the mean where your online retailers, healthcare, and home improvements, while they've done well, they've actually lagged some of these more downtrodden sectors. So I think what we're seeing very simply is the market looking past some of the noise. Now, all of that with the caveat of 2021's outlook is built on and it hinges on health outcomes, right? Specifically, an effective combination of vaccines and therapeutic treatments. If there should be any sort of disruption in any of that, everyone should have an expectation that there's going to be additional volatility in the market, much like what we saw last year.
Gotcha. So I'm going to ask you to whip out your crystal ball for a moment, and in terms of general outlook for 2021, what's anticipated? What are likely to be, which areas are likely to experience growth, or which areas are likely to experience contraction in 21?
Sure. Well, let's take a past date, right? Like I mentioned, November 9th. Equity markets on November 9th saw one of the largest momentum changes in history, which is these hard-hit value sectors, again, energy, retail, hotels, they've all rallied. And I think that is something that is most analysts expect to continue, right? This is a return to normal, not something that's totally outside of the box. I think another potential outcome is, and most analysts expect this, interest rates are going to remain low all through 2021, which is what you would expect with government borrowing the way that it is. Without any short-term rise, the expectation there is fixed income returns are going to be somewhat muted. The real risk throughout 2021 as it unfolds is going to be higher than expected inflation. That being said, most of the analysts that we work with and our internal research folks are expecting modest to positive returns. So much like 2020, the expectation is a disciplined investor will be rewarded in 2021.
Well, that's certainly good to hear. James, thanks for taking the time to connect, with us today. Really appreciate the opportunity to learn a little bit about what's happened in 2020 and then also looking forward to 2021.